Hey, welcome back, guys. All right, so another topic that we have so many requests for information on, and that is investing. So, the video today is really just going to be a primer, an overview of investing, and don't be frightened. There's going to be a little math. So, this is going to be like investing, real estate investing, investor mathing. How about that? Or simply said, let's look at some numbers that determine if a investment opportunity is a good opportunity for you, a investor. How about that? All right. So let's take off. And first of all, let me say this: that I want to really focus on residential real estate investments today. Uh, Commercial investing is definitely a viable option for a lot of folks, but that's an entirely different conversation. The numbers work a little bit differently there, and other things to consider. So for today, it's going to be residential. So there's generally three ways that you can be an investor in residential real estate, and that doesn't matter if it's a single family, if it's a multifamily, which would be as small as a duplex, a triplex, a quad, or more than four in an apartment complex. It doesn't matter. The numbers generally are going to work the same when it comes to residential investing. And there's three ways to do that. Number one, you can own rentals. You can own real estate that produces revenue each month through rent money. Number two, you can flip. You can take a home that needs to be repaired and updated, and you can buy that house, do the repairs, and then resell it for a profit. Or number three, you actually can be the lender. And I know you may be saying, how in the world could I become a bank? Well, it actually is more common than you think. But let's jump into these. And the first thing that we'll look at today is owning rental properties. So the first thing about the rental properties that you want to look at from a number standpoint is something called the 1% rule. Now, the 1% rule, it's just a rule of thumb. I heard a mentor one time tell me that the 1% rule is kind of like licking your thumb and trying to figure out which direction the wind's blowing. It is not the end all, but it is just an idea of how will this investment work? How good will it work? The 1% rule looks like this. The monthly rent should be about 1% of the purchase price. So, for example, if a property rents for about $1,000 per month, according to the 1% rule, the right amount of purchase price for that property would be about $100,000, because $1,000 is 1% of $100,000. So if a property rents for $750 a month, then as an investor, I want to try to purchase that property somewhere in the neighborhood of $75,000. And this rule holds pretty well. And here in central Alabama, you can still get properties really close to this 1% rule. It does, however, lose its credibility as you get to higher price homes. So in other words, for a home that would rent for $2,000 a month, you're probably not going to be able to purchase that for $200,000, right? So you do get to a point where, depending on where the house is located and in what neighborhood, that rent might be $2,000 or $3,000 a month, but that's not going to translate most likely to a purchase of 1%, like we talked about. So that was the 1% rule. Here's another number that's important to real estate investors, and that's called cap rate. You'll hear that a little bit more when you look at multifamily investments. But the cap rate is simply the net income from operations divided by the purchase price. Gives you a percentage, which we call the cap rate. So we'll get into the numbers in just a second. But what is a good cap rate? What target would you want to look for? Well, in some parts of the country right now, you probably can only get a 2 to 3% cap rate. That means the purchase price is so large that the net income annually is only 2 to 3% of the purchase price. Here in central Alabama, it is definitely possible to find a property and purchase it at a price that can give you 7, 8, 9, maybe even 10% or more on the cap rate. So let me explain that a little bit more closely. So here's how we calculate cap rate. Let's assume that a property earns $1,000 a month in rent. That over 12 months is $12,000, right? Let's also assume that the property manager takes 10%, so that's $1,200 per year. Let's assume that property taxes are, in this example, $750 a month. And let's assume that it costs about $2,000 a year to do whatever maintenance and repairs are needed for that. When you add those together, you get $3,950. Those are your annual expenses. So what you do is you take $12,000 in gross revenue, subtract the $3,950 in expenses, and that leaves you $8,050. That's your net revenue from operations. Take that $8,050, divide by the purchase price. Let's assume in this case you paid $100,000. That leaves you about an 8% cap rate, which if you look at those numbers again, remember what we talked about with the 1% rule, that this is a great example of when you manage your expenses, the 1% rule will give you about an 8% cap rate. And that holds true to form in a lot of different scenarios and a lot of different properties. So that's the cap rate. What are some other factors that are really important related to making sure that your investment gives you the returns that you want? Well, number one is a property manager. You want a good property manager because a property manager is going to, number one, make sure that your rent is truly market rent. And you, as market rents go up, you want a property manager who will encourage you to increase your rent along with the market. But at the same time, a property manager knows that when they find a good tenant, they want to make sure that they can keep that tenant in there long term, because a good tenant over the long term will cut your expenses. Why? Because every time you get a new tenant, you're going to have to go in and do, new flooring, maybe new carpet, new paint, some minor repairs to freshen up for the next tenant. So the fewer tenant turns you have, the less expenses that you will have as well. Another factor that will help improve the results of your real estate investment from owning rentals is actually knowing and working with an investor-friendly realtor. An investor-friendly realtor is always going to know that his fiduciary responsibility is to you, his client, and what that means is he's going to work really hard to protect your interest. A good real estate friendly realtor will be focused on your overall value, your overall investment of this purchase, not just the details of the purchase itself. All right, what are some tools that you can use when you're looking for real estate rentals? Number one, there is a document that a lot of investors use, including myself, called an annual property operating data sheet. Annual property operating data sheet, or APOD for short. And here's what that does. That lists out the property revenues, the property's expenses, it calculates cap rate, it gets all the numbers on one sheet of paper. Why is that important? Because it takes the emotion and the guesswork out of evaluating a purchase. So again, as an investor, most of the investors that I work with, they come to me when they find a property that they want to look deeper into. They come to me with having an APOD already completed. They already know the numbers will work before we actually go look at the property. Another tool that's important when evaluating a real estate investment is inspections and the property history. You'll want to be able to make sure that the property itself is in good working condition. You want to make sure that you would feel comfortable having a tenant live in there and that you minimize any exposure to liability. And also you want to make sure that you're not going to have to make any large purchases like a roof or an HVAC system that would be a surprise to you after you close on the purchase. All right, flips. So again, 3 ways to make money in real estate. Number 1 is owning rental property. Number 2, flips. So what do we mean when we say flips? Well, here's what that means. That means that you as the investor would buy a house for a certain amount of dollars, put the money into it to do repairs and update it, and then sell it for a profit. So there is a little math with flipping too. There's something called the 70% rule. So what's a 70% rule? Here's what it means. It means that it is a way of determining how much money you should offer for a flip. So you start with the ARV, or the after rehab value of the house. In other words, what should the house sell for after after your flip is complete? That's called the ARV, and a good investing realtor will be able to help you with that. Here's one thing about understanding your ARV. Don't kid yourself. Don't be overly optimistic. Don't be overly pessimistic, but don't be overly optimistic, because here's what happens. You take that ARV and then you multiply that by 70%. You subtract from that the amount of cost of rehab necessary, and that would be your offer price. So if the house sells for $300 after the flip is completed, you multiply $300,000 by 70%, and that 70% gives you a value of $210,000. Let's assume that in this case the house needs $75,000 worth of work. You subtract $75,000 from your $210,000, and that leaves you $135,000. That means that your offer price for this house should be no more than $135,000. By the time you make that purchase, do the rehab and sell, you should have a little profit built in there for you. So that's how the 70% rule works. So if you want to flip a house, how do you get the cash? Because when you do a flip, because of the repairs that are typically needed, a conventional loan is not going to work, and most people don't have this much cash ready to go. So what's your alternative? Well, the alternative that most professional flippers do is they either pull funds from their network, or number two, they use what's called hard money loans or private money loans. This basically is a company or a group of individuals that are not the mafia, but they are what we call hard money lenders, and that means they loan cash specifically for flips. So they understand everything about doing real estate flips, and they're used to that. Now, what this means generally is that they're going to loan you the money for the rehab, most likely, and for the purchase, and probably you're going to be at maybe even double the interest rate, almost double, or maybe a little above double of the average conventional loan interest rate. But you're not going to carry that interest rate for 30 years. You're going to carry that for about probably 6 to 9 months while you're working on the project. So hard money lenders are a fantastic way for a flipper to be able to buy a home that needs repairs, do the repairs, and then resell it. Again, your go-to realtor who is experienced with investing in real estate will know how to connect you with solid, reputable, and great companies to work with. All right, the final way to make money in real estate investing is by being the lender. And you may say, how in the world can I be? I don't want to be a bank. You may be a physician or a veterinarian, or you may be an attorney. You don't have time to be a bank. Well, guess what? There are a couple of fantastic ways for you to be able to deploy your money in the real estate industry, and you especially if you don't want to run a rental company, or number two, you don't want to coordinate and project manage a flip. And you really can do that in a couple of ways. Number one, you can be a silent investor in with a reputable flipper who just needs the cash to go. Or number two, you can actually partner up with a company that is a hard money or a private money lender. They generally are looking for sources of income, and when you send them that money, they're going to quarterback and project manage flips for you, and then they will give you a specified payout based on how those investments do. An example of this is REI Funding in Tuscaloosa, Alabama. It's a fantastic company. They've been around for a really long time. They know what they're doing, and they have a program set up for individuals who want to be in the investment world of real estate, but they just don't want to play an active role. So that's a great alternative. And then finally, there are such things as real estate investment trust, REIT. Generally, I didn't want to leave this out of the conversation, but generally these are large groups of investors, and they work on really large projects. But you don't have to be a part of that in order to be a real estate investor. All right, so we've thrown some numbers at you, a lot of information at you. We hope this has been really helpful. If you have questions, certainly we're just skimming the surface of real estate investing. But if you have questions, reach out to us. We are Mike and Brandy Brown with Keller Williams, Birmingham, Alabama. Feel free to call 205-368-5995 or email us at info@mbrownrealty.com. Thanks.